When a corporation evaluates building a new facility, it commits millions of dollars upfront for cash flows that will not materialize for years. To justify that outlay, executives need a precise metric to measure the expected return. That metric is often the internal rate of return, or IRR. It represents the estimated compound annual growth rate a specific investment is expected to generate over its lifespan. This graph maps that relationship mathematically. It plots a project's net present value against an increasing discount rate. As the applied discount rate steadily increases along the horizontal axis, the present value of the project's future cash flows drops. Right where the curve intersects the axis, the net present value drops to exactly zero. That specific intersection point is the project's internal rate of return. Isolating this number provides financial managers with a single, highly digestible percentage. It communicates the project's intrinsic profitability entirely separate from the external costs required to finance it. To use this percentage in practice, companies establish a baseline hurdle rate known as the cost of capital. This is the blended interest rate the firm pays to procure funds for its investments. The primary capital budgeting rule is straightforward. To generate value, a project's expected internal rate of return must strictly exceed the company's cost of capital. If the expected return is higher than the financing cost, you accept the project. If the return falls below that threshold, you reject it. This binary framework works flawlessly when evaluating an independent project in a vacuum. The math becomes complicated when a company must choose between mutually exclusive projects, where selecting one means abandoning the others. This slide from an MIT finance lecture outlines the standard textbook criteria. It confirms that for independent projects, any IRR above the threshold is accepted, while for mutually exclusive projects, the rule dictates selecting the single option with the highest rate. While this logic successfully filters out individual investments that lose money, relying purely on the highest percentage to rank competing options creates a significant operational blind spot. Because the internal rate of return is expressed as a relative percentage, it strips away context. It completely ignores the absolute physical and financial scale of the underlying investment. This table illustrates the scaling problem. Project 1 shows a massive 100% IRR on a $10,000 investment, but Project 2 requires twice the capital, generating a lower 80% IRR but far more net present value. The metric also ignores differences in duration, biasing decision-makers toward short-term projects over longer-term investments that accumulate greater total wealth. A 50% return on a small initiative looks impressive on a spreadsheet, but a 15% return on a massive infrastructure build adds substantially more absolute cash generated to the balance sheet. This dictates the definitive rule of capital budgeting. Whenever the internal rate of return ranking conflicts with the net present value ranking, always follow the net present value rule. IRR is an effective gauge of capital efficiency, but percentages do not pay dividends. Absolute cash does. Net present value remains the ultimate measure of shareholder wealth creation.